So we're going to continue our discussion of real estate investors and how they use whole life insurance, but we're going to look at a model today. We're going to look at different policies. I should rephrase. We're going to look at one individual with one company and one product, but three different assumptions we can put together. And the purpose of these different assumptions, when you look at using the policy for real estate, will benefit you in the sense you can see what the actual growth rate is, meaning what is the policy growing by, and then what are you paying in loan interest. This way you can see, is this policy benefiting me when I am using it for my real estate purchases? Because if you're a real estate investor, what you are very, very good at is real estate investing. You know how to generate the highest return, what cash flows you're comfortable with, maybe it's a flip, whatever it is, that is your level of expertise. That's your area of expertise. However, when it comes to the policy, you may feel overwhelmed sometimes. You hear that it's a good idea, but then when you look at the numbers, it doesn't always make sense. And if you're like me, sometimes you start to go down a certain road or strategy and say, okay, I think it works out, so I'm just going to kind of do it and hope it does, which does not always work out well. I've become more analytical over the years, depending on who I'm working with. Some people, if I trust them, I'm like, all right, if you've done the work there already, I trust you 100%. But anyway, let's get back on track. What we're going to look at here is a case. We're going to look at a 57-year-old female. And from a design standpoint, because this is step one. If you saw the last video, what do we have? Rates, illustrations, but then policy design. This is where it all starts. This individual is interested in getting a total of $1 million into a policy, and this is a lump sum, meaning they do not want to be on the hook to continue to make premium payments. This is extremely common among individuals. They had a lump sum come in. They'd like to move it into a policy. After that, they're done, meaning they do not want to have to keep on adding money to the policy. Then with the option, sure, if I can keep doing it, it's great, but man, I do not want to. This is just money being moved from cash into the policy because I like the benefits here. So maximize the cash value first, make sure I'm not on the hook for any future payments, but what I am going to do is use that big bucket of cash value like this line of credit over the years. So what we're going to look at is a 3-pay, which means we're going to break the funding up over first year, it'll be $340,000, and then the next 2 years, it'll be $330,000 for a total of $1 million. So let's take a look here, and we will first look at the design, then the different assumptions here. So when you're considering a policy, you will receive something like this. This is a life insurance illustration, which gives you a breakdown as to where your money is going. I should say this is one page from a life insurance illustration. We see this one 16 pages. Many are much longer than this. But here's what we want to look at here. This column, net after tax outlay. It's the same as net premium. This displays her actual out-of-pocket here. So what do we see? The first year, $340,000, and the next 2 years, $330,000. Then what do we see? Zero thereafter. There's still a premium due, but she's not paying it. We've got other videos that go over exactly how this works with a life insurance policy. If you are looking at the bottom line, there's your net cash value, along with the net death benefit. This is a life insurance policy. The death benefit is at a bit of an oddball number, $4.7 million. Where we came up with that is because of this guy. Core benefits to a life insurance policy are what? If you saw the last video, you know this. Core benefits: safe, liquid, and tax-free. Tax-free if we do not trigger a taxable event. A taxable event with cash value life insurance is what is called a modified endowment contract. So in order to prevent this modified endowment contract from occurring, What you'll see is a modified endowment contract limit, which in short is a MEC limit. So what has a direct relationship to that MEC limit is an individual's age and total death benefit. There are other factors such as the guaranteed rate and such, but my point is this death benefit is the minimum death benefit we could have in order to have a MEC limit of $340,000. So we solved for the minimum death benefit to minimize costs and then maximize cash value. So the other big question here, if I'm you, and I'm looking at the design piece first, be this: where is my money going? Because we know what? We know that there's $1 million going in, but where is it going? Because money can go where? Go back to that whiteboard again. Money can go toward a premium piece or this PUA rider. What are you committed to? Premium. So I want to be able to commit to a minimum amount, then add more at my discretion. Making it flexible prevents the policy from feeling like a large bill or a burden. So in this case, of that 340, where is my money going? Up here is the premium, $30,000 even. Then below that, what do you see? Not this indexed participation feature, that's at 0%. We're going to ignore that in this video. We see this term. Remember a PUA rider, paid up additions, there it is. Now you'll see scheduled and also unscheduled. We've got $5,000 scheduled. So what that means, if this is you, the amount that you will be billed for every year is the premium and the scheduled PUA. $35,000 per year is the minimum. Why we set it at $35,000 is because that scheduled PUA first covers the cost of the term insurance. OYT represents 1 year term. And then the rest is allocated toward PUAs to build cash value. Now, very, very quickly, the purpose of term insurance with a life insurance policy has to do with that MEC limit. What it is a cost-effective way, or you could say a cheap way, to raise the death benefit, which raises the MEC limit. Because I want to keep this premium low, because what takes the biggest bite out of cash value in the first year, what doesn't show up in cash value, whatever that premium is. So we're minimizing that in order to maximize cash value. So with all of that said, premium at 10%, it's actually less than 10%. It's as low as we could drive it in this illustration. When that's minimized, that will result in more money going toward PUAs, and you see it unscheduled here, which means you can add it at leisure, not required to either. If you don't add the money or add a lesser amount, you will see it reflect in lesser numbers, but it's flexible here. This way you're not billed for it every year. But here we've got the funds going in, and there's your net cash value. Break-even point is when? Between years 3 and 4, when we look at it. So again, we're talking about real estate investors here, and this is on policy design. Important step here. Maximize the cash value first, because what does this do for you? This gives you more access to capital to then do what with? Use it for this. That's what people are looking for. Every time I have a conversation with a real estate investor, business owner, or anyone really that's looking to actively use the policy, what they want to do first is maximize this so they've got more capital for other opportunities. Like that is the focus. All right, so we looked at policy design. Now let's see how it relates to this. We're going to look at both rates and illustrations and numbers. This is the big thing, transparency around the numbers, what your cash value is actually growing by, not the dividend rate, compared to what you are paying in loan interest. So let's get on into it. Here's our illustration, and just take note of the year 4 cash value, year 5 cash value. What do you see there? $1,044,000 and change when we look at it. Okay, cool. So what we're going to look at is a simplified version of this. And what do you notice about the year 5 cash value there? $1,044,000. What we did was just export the values from the illustration to Excel, and there we go. So this is one product or one variation of this product. What we're going to look at is also this in an effort to provide transparency and some awareness, what to look out for when we're looking at illustrations and such. If we don't have awareness, we don't know what to look out for. So let's begin with the first one here. So we've got the funding, there's the illustration. Here's what we like to do. Plug it into this guy. And for now, just focus on everything underneath policy values in green. I know it's a lot of information. All right. So what we've got here, in fact, let's do this first. Annual outlay, there's your funding, there's your cash value. Here's your annual IRR. This gives you, from a growth rate standpoint, what your policy is growing by year over year. First year, you paid in $340,000. You have $300,000 in change, which no matter how you spin it, comes out to a loss of 11.55%. That's why we see negative 11.55. The next year, however, should say at the end of the first year, you had $300,737. You paid $330. Now the cash value is worth $637 and change. So what happened here is you got your $330 back plus another 1.04%. So this IRR displays the net growth rate that your dollars in terms of a rate that you're actually receiving from the insurance company here. Next, we've got yearly cash value growth. If you prefer dollars instead of rate, this is going to give you exactly that. So, first year, that negative 11.55% came out to what? $39,000 and change. When we look at the difference with what we paid in compared to what we actually have in cash value, just about a $40,000 hit when we look at it. There's the exact dollar amount. Then year two, $330. Got it back, plus another $6,500. So this is the net dollar amount that I'm receiving from the insurance company on a yearly basis. To the right of that is the total gain on cash value. So what do we see here? First 3 years, you've got less in cash value than what you have paid into the product. By year 4, you'll see it highlighted in yellow. You've paid in a total of how much? $1 million. Your cash value is $1,013,000, which is then a gain of $13,000 in change. So if we look at this at age 70, their total payments are still $1 million. Cash value is $1,469,000, which gives you a gain of $469 and change when we look at it. So the annual IRR shows the net growth rate this policy is growing by every year. Then to the loan side. So this is it right here. When I look at loans, LTV at 95% of cash value. 95% in most cases is about the maximum loan you can take against your policy. So if I've got a cash value balance of $1 million and I ask what is the maximum loan, usually it'll be 95%, which would be $950,000. Some companies are a little bit higher, some are a little bit more conservative. This is a good number just to set expectations. Loan interest rate, in this example, 5%. Different companies will have different rates. Full disclosure, this workbook does not model exact policy loans. It's not in the illustration software. That is something we do when working with individuals to provide net numbers from the insurance company. This is a net workbook that will give you very, very close numbers. It's just much, much faster and clients like to use it. So what do we see here? 5% loan interest rate. At what point in time do you see your annual IRR hit 5%? Never. So let's take a loan out here. Why don't we use what we discussed in the last example, in the last video, where if we look at year 6, you've got just over $1 million. Remember what that individual that I was speaking with was frustrated about? He was frustrated because he saw cases like this where someone had $1 million in cash value and they were shown a loan of $200,000 And then what we see is, okay, if you take a $200,000 loan, you've paid $10,000 in loan interest, and you've earned, if we look at under the blue section here, you've earned $31,000 that year. So what's happening here in year 6, 5% cost to borrow, 5% of $200,000 is $10,000. That's what you've paid to the insurance company. Here we've got annual interest payment. If you've got a cash value collateral loan with a third-party lender, that's what you're paying to them. If we look at the yearly cash value growth, it was $31,000 that year. So you are ahead. However, to be fair, you're compounding on over $1 million here in year 6, almost 1.1 at 3%, and paying 5%, but only on $200,000. So what we want to look at then is what happens if we increase the loan? What if we went up to $500,000? What happens? It's all numbers. Keep your eyes right here. Yearly cash value with yearly interest payment. What happens if you take 85%? $850,000. At 5%, you're paying $42,500. The growth is $31,333. You're behind. It's really just being able to see the numbers up front, which is what people want to look at. So if we paid interest only for a number of years, what happens? Well, you're paying interest on the $850. This is a fixed rate we're modeling here, by the way, but you are still receiving compounding on the total balance. So in this case, I will see it catch up, which is nice. However, if I'm constantly taking out additional loans, then I'm going to constantly put myself behind. Let's say you did this, but then you begin to repay it at, I don't know, 10 grand a month. What's it look like? This right here is what people like to look at, in particular, this section. And isolating what I'm paying in loan interest with what my policy is growing by. So I can see if I've got a really noticeable negative hit where it makes me feel like I don't want to do it. Just seeing that beforehand is what helps. And this is all assuming annual payments and annual interest payments. If you've got a habit, or anyone has a habit, of attacking a loan aggressively and paying that loan down, what's going to happen? Well, you're going to save yourself in some interest costs and put yourself in a better overall position. So it is good to have awareness on that too. But the other thing I wanted to mention, so the illustration we started with is the illustration that displays the most conservative internal rates of return and most conservative cash value growth, which is what I would recommend looking at. When I say most conservative, I'm not talking about guarantees. I just want to be clear on that point. When I say conservative, of the 3 different examples here, it's the most conservative. But I do like to always look at the most conservative. In my opinion, it can be risky to lead with just good-looking numbers or only show just the best-looking numbers. Because if you take out a product, you take out a policy, and you see the best-looking numbers, man, this is earning over 5% with this particular rider or whatever it might be, and then it only produces 3 or 4%, how do you feel? Expectations were set here, delivery was down here, you don't feel that great. Versus, what if expectations are set here at 4%, and then delivery is up here at 5%? Now all of a sudden we're happy. So leading with realistic expectations is beneficial. All right, so let's look at the other 2. So we've got this same product, but with a 10% PUA fee. Without getting into the details, this option does offer greater long-term potential when we look at policy performance. So what we can do is plug the values in here. The funding is identical, so we don't need to change that. But what do we see when we look at it? IRR, instead of negative 11% in the first year, is negative 16%. How about this? Year 2, not positive, negative 0.9%. Then picks up the pace. Do you recall from a rate standpoint where that internal rate of return topped out at with the last product? It's about 4.1%, right around that area. What's it here? It's a little bit more attractive than 4.1%. Tops out at 4.75% annually, and it is stronger throughout. And based on the non-guarantees, you will see this. On the guarantees, it's the opposite. But different strategy here that does offer a little bit stronger long-term potential. One thing I gotta do is make sure we highlight what years we're in the red. So here actually, because we have less cash value up front, if we see a negative in that column, that means we've overloaned and we wouldn't actually be able to take that much out. So what we could do here is reduce that year 2 loan. Oopsie daisy, one too many zeros. And that what we just highlighted there too. So here's a product that gives us more long-term potential. We see a greater internal rate of return when measuring the long-term performance, but we had less up front. A lot of business owners and real estate investors look at those early years very, very closely because they do view it as an opportunity cost. Where if I see, hey, $15,000 less I've got access to there, I don't know if I'm comfortable with that. I'd rather take a little bit more conservative growth rate when I look at the IRR and cash value, but then have the assurance that I can access more money in the early years, because really where my money grows is in my real estate. This is just a nice area to put it. So it's always how the individual views it. But again, that's just a little bit of insight as to how some people think and approach this. Let me correct the loan payments too. 40 that year. There we go. We took out less, so we've got to repay less. But the exact same thing here. When am I in the black compared to when am I in the red? Now I want to see something cool, but at the same time dangerous. You'll see what I mean. Here's the third illustration, and notice here we've got index demonstration. So this is an indexed rider. We can attach to a whole life insurance policy, and this is specifically with Guardian. But this does offer greater earning potential when we look at policy performance. In fact, if you look at the internal rate of return, what do you notice? It's over 5%. So if I can loan at 5%, now all of a sudden I illustrate something that's positive. Now again, if we're looking at a life insurance illustration and I have a direct recognition loan and it's with Guardian, things are going to look much, much different than this with how their direct recognition treatment works. But my point is, this is setting expectations too aggressively, in my opinion. Because in reality, what we usually see when we look at whole life insurance and policies that have actually lived the test of time is an IRR, call it right around 4%. Some have done much better, but they were older policies that lived through high dividend years. But if I've got an IRR of 4% and I'm going to loan, and that's going to cost between 5 to 6% on average, what's going to happen? If I take out maximum loans, I'll be negative for a period of time. But that's the kind of stuff we want to see up front. So I hope that this was helpful just from an awareness standpoint. Those models we looked at, if you are using a policy actively, if you're a real estate investor and you want just transparency on the numbers, I would look at something like that. See if your agent can put it together. And it all starts with looking at your illustration. That's the best way to see the numbers from the get-go, whether it's a new policy or an existing policy. You can look at an in-force illustration. You can even back test it too, or backtrack it. We can look at, if you've had a policy for 10 years, we can look at what the actual cash value growth was. If you took loans, what did you take? How much did you pay in loan interest? What did you receive in actual cash value growth year over year? And then you can compare them side by side. So it is possible to see what has already happened, but what most like to do is see what would it look like if I do X, Y, and Z. And then what it really comes down to is just plugging the numbers in to give us a quick idea. Full disclaimer, the numbers will never be 100% accurate because things change over time. We talk about that when we discuss historical performance of whole life insurance and such. But anyway, I do hope that you enjoyed this. If you did, please hit the like button. Feel free to leave any questions or comments below. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, Please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.